Hello, welcome to another video on how to secure yourself financially. So right now I'm going to make a quick recap of the beginner guide to financial statement, which after all, it shows you the money, and there are four types of financial statements. Balance sheet, which shows you what a company owns and what it owns at a fixed point in time. Cash flow, which shows the exchange of money between the company and the outside world. Income statement, how much money a company made or spent during a period of time. And the statement of the shareholders, that show is the changing interest of the shareholders over time. So the TLDR for the balance sheet is that it shows you a snapshot of the company assets, liabilities, and shareholders' equity over a period of time. The income statement shows you the net, or the bottom line of this show you is if a company made money or not. Okay, and then the cash flow statement, a report that shows the company's inflow and outflow of cash. And this is very important because company need to have cash on hand to purchase assets or pay this expense or pay its expense. So the cash flow statement, in contrast with the income statement, that it shows or it can tell whether if a company make a profit, the cash flow statement show you if a company generate cash. And the bottom line of this statement show the net increase or decrease in cash over time, and it reviews some of the information of the balance sheet and the income statement, and it's generally divided into three main aspects. So you have cash flow from one of these three main activities, or these business activities: operations, financing, and investing. So the operating activities, it conciliate or it analyze first the net income from the income statement, and it conciliate with any cash that was used or perceived from operating assets. So the way to do that is it adjusts any it adjusts the net income for any non-cash items, so items that affect the income statement but there is no cash transaction, such as stocks, base compensations or amortizations, and depreciation, for example. And it adjusts for any cash that was used or perceived from other operating assets. And then I ask myself, okay, so what are the most common operating assets? So you have is inventory, prepay expense that you have to make in advance to enjoy a particular service or good in the near future, such as premium insurance like health for medical coverage, home or vehicle, so to protect that in case of fire, accident, or potential damage, life in the event of the policyholder's death, as well as liabilities like lawsuits, disability that prevent you from working, and long-term care such as nurse home care or home health care. You also have is rent, marketing, office supply such as paper or imprint, as well as software license and maintenance contract. And when I look at other operating assets such as accounts receivable, where here there is not nothing too much to say about that. Intangible assets such as patent. Oh my god, I hope you can hear me. This is part of the challenge of record in your own environment. Okay. All right. Thanks. Move on. So we have intangible assets such as patent that provide exclusive right to original inventors or inventors to manufacture and sell their invention over a period of time, such as maglev, this magnetic levitation or this electromagnetic levitation, stabilization and suspension system for ground vehicles issued in 1916, according to popularmechanic.com. That's actually very, very interesting to look at it. And you also have is the GPS, this navigation system with satellites using passive ranging techniques, issued in 1974. The iPhone, or as their patent name, electronic device. Chris gene editing, issued in 2014. You also have, for example, now looking at the intangible assets, trademark, such as symbols, design, words, that uniquely identify this company from the competition. So, for example, Michael Burry, so he has his own phrase, "Let's get ready to rumble." Copyrights, where now it provides exclusive rights to creator of original content or work to use, sell, and distribute that, such as Netflix, Twitter, Coca-Cola, or McDonald's. Trade secrets, which are confidential data that company use to get a competitive advantage, such as process, customer lists, and formulas, customer relationship, and goodwill. There are other intangible assets, but these two cover, for example, the goodwill cover is the brand recognitions, reputations, and customer loyalty. So great. Then I look at investment in affiliate, which is another operating assets, such as joint ventures, where now two or more companies join together to undertake a specific business activity or a project where each company receives a share of the joint venture. For example, Crocs and Post Malone, right? Equity investment, this is something fairly known, where now company may purchase significant stake of that company's stocks to gain some influence and potentially gain a voice in the other company management decisions. For example of this is like Berkshire Hathaway, which is a multinational conglomerate holding company, and the holding company, after all, is a parent company that, instead of engaging with operating activities or business activity directly with all of the other company, it does that by own shares most of the time, a huge majority of the share, but it owns shares to other companies. So Berkshire Hathaway is this conglomerate multinational holding company that invests in a variety of industry, such as retail, energy, and Oh, come on. Such as retail, energy, and finance as well. So then another example is SoftBank, where now this is a Japanese conglomerate. Yeah, let me mute here. All right, much better. All right, cool. I suggest you to skip the video until all of this happens, because right now this is in real time, you know? Okay, thanks, Jesus. Okay, another example of equity investment is SoftBank, okay? Where now this is a Japanese conglomerate multinational that invests in primarily technology companies, such as WeWork, Uber, and Airbnb. Another example is the Alphabet, the parent company of the Google. And again, this invests in a variety of technology companies such as Calico, which is focused on health. Okay. Um, and then other example, okay, like TPG, which is a global private equity investment firm that the most notable investment is Airbnb, the Texas Pacific Group, and the Blackstone Group, which is an investment firm that invests in a variety of uh, business, whether it's on the technology, home health, in real estate. An example is this company invests in something called, or in this online platform, this online educational platform called BU, B, B, BU. There you got it. Which is kind of the competitor of Khan Academy, headquartered in Bangalore, Kartana, India. BUs. Okay, this is on the field of education, or this is in the industry in the uh, educational platform. Cool. Then another example of investment in affiliate is limited partnership. So when a company invests in a partnership that provide control, or that provide control of assets. This is something that I ask to this, that provide share of ownership and control over the partnership assets and operations. And this is something that, okay, you have to be careful, especially when perhaps when you're working with a particular company. And this kind of investment vehicles are primarily used for real estate and sorry, are primarily used for real estate and uh, on real estate uh, and private equity. This limited partnership and the associate, right? Where now here this is a company in which the investor may have share a significant amount of share, which uh, have a significant influence on the other company, typically between the 20 or 50% of share of the other company. So that's great, because now I can walk through that process of looking at the operating assets, okay? Accounts receivable, inventory, prepay expense, plant, property, and equipment, intangible assets, investment in affiliates, okay? And then I look at the investment or operating liabilities, okay? Operating liabilities here, we got is operating activities, operating liabilities, like accounts payable, all right? Accounts payable, accrue expense, meaning as well as defer revenue, as well as income tax, and short-term borrowing. Then liabilities, notes payable, current portion of a long-term debt, notes payable, current portion of long-term debt, customer deposit, and warranty obligation. So another is deferred tax assets, okay? Deferred tax assets and cash equivalent. So after I see the most common example of operating assets, like accounts receivable, inventory, property, plant, and equipment, prepay expense, intangible assets, investment in affiliate, deferred tax assets, cash and cash equivalent, okay? Then I look at the operating liabilities. So accounts payable, okay? Accrue expense, here we are. Okay. Accrue expense refers to expense that a company has incurred but has not yet paid for record in its account. Accrue expense. So how do you say that in Spanish? Accrue expense. Interesting. Accrue. Accumulated, accrued. Okay, accrued expense. Okay, accrue expense. Okay, expense that a company has incurred but has not yet paid for or recorded in its account. Okay, account expense. In the Spanish is gastos acumulados, accrue expense. So it refers to expense that a company has not yet expense that a company has incurred but has not yet paid for or recording in its account. And these expenses are recognized in the company's final statement as liability. So they represent an obligation to pay for good or service that has been received, but from which payment has not been yet made. Okay. So accrued expense represents an obligation to pay good or service that has been received. Okay. There are expenses that a company incurred but has not yet paid for. So for example, salary and wage. If a company has employees who have worked but not yet being paid, those wage and salary will be considered accrued expense. Rent If a company rents office space and it has not yet paid its monthly rent, that rent will be considered an accrued expense. Utility. If a company has received utility service such as electricity, gas, or water, but has not yet paid for those services, they will be considered as an accrued expense. Okay, utility. And taxes. If a company has incurred taxes such as sales taxes or payroll taxes, but you have not paid them exactly. So in any case, any expense that a company has incurred uh, synonym. Okay, so any expense that a company has incurred but has it's the expense that a company has incurred but has not yet paid for or recording in its account. So this expense represents obligations that a company have to pay for good or service that has been received or consumed. So for example, salary and wage, rent, utility, and taxes. Okay, okay. Pretty straightforward. Okay. Any expense that a company has incurred but has not been paid yet. But has not yet paid for. Okay. So any expense that a company incur but has not yet paid for or recording in its account. So this expense represents its obligations to pay for good or service that has been received, such as wage and salaries, rent, utility, and taxes. Okay, interesting, very, very interesting, and good. Mhm. Okay, now operating liabilities, liabilities like deferred revenue, meaning, okay, that was pretty straightforward. Actually, it was very, yeah, it was pretty straightforward. It was. And then we have deferred revenue. Deferred revenue refers to payment received by a company in advance for good or service that has not been for service that has not been yet delivered or provided. Deferred revenue. Okay, payment that you receive payment that you receive in advance for good or service that have not been yet delivered or provided. And liability, of course. Deferred revenue. In other words, it represents revenue that has been collected but has not yet been earned. Okay, you collected but not earned, but has not been earned. Deferred revenue is recognized as a liability on the company's balance sheets until the good or service are delivered or provided. Once the good or service are provided, the deferred revenue is recognized as revenue on the company income statement. Example of deferred revenue may include subscription service. So exactly, it's a company that already received that, and most of the time, for example, Netflix, Spotify, this subscription service, they actually do that. You have to pay in advance to enjoy this. This is not accrued expense. This is defer revenue. What does it mean, defer? Diferido in Spanish. Defer revenue. Okay. Accrue expense Okay, so expense that a company has incurred but has not been, but has not, yeah, expense that a company has incurred but has not yet paid for or recording in its account register, or record in its yeah, or recording in its accounts. So this expense represent is obligations that a company, yeah, this expense accrue expense, this represents um, obligations that a company needs to pay for good and service that has been received. Exactly. So once I receive that as a company, then I'm going to pay for that. Okay. So in other words, account expense, once I receive that, in other words, account expense is something that I receive that, okay, something that I received that, but I haven't paid for it. Okay, so there, something that I received but have not paid for it. So in the case of company, wage and salaries, rent, uh, utility, taxes, and accrue expense. Okay, but in other words, is this accrue expense are expense that I'm enjoying, but I haven't paid for it. Okay, expense that I, or obligations that I have to pay for the good or service that I receive from. Okay, such as wage and salaries, rent, and utilities, taxes, and defer revenue, because one of them is accrue expense and the other is defer revenue. Refers to payment received by a company in advance. Okay, this is uh, payments that a company receive in advance for goods and service that has not been yet delivered or provided. In other words, it represents revenue that a company has collected but has not yet been earned. So deferred revenue is recognized as a liability on the company balance sheet until the good and service are delivered or provided. Once the good or service are provided, the deferred revenue is recognized as revenue on the company income statement. So example of deferred revenue may include subscription service. If a company offers subscription-based service such as software or stream content and receive payment for several months of year in advance, the portion of the payment that relate to the future period will be considered deferred revenue, meaning a liability for the company, an obligation to provide that service. Okay, subscription service. Prepay maintenance service. If a company prepay maintenance service. If a company provide maintenance service for its products and receive payments for several months or years in advance, the portion of the payment that relate to future period could be considered deferred revenue. Gift card. If a company sell gift card and receive payment for them, the value of the gift card has not been redeemed will be considered deferred revenue. Exactly. So those gift cards that haven't been redeemed or consumed, it is still a deferred revenue for the company. Deferred revenue is important to track and manage, and it represents a future obligation to deliver good or service that can impact the company cash flow and financial positions. Totally. Totally. Okay. I will make a pause. I'll make a pause here. I'll be right back. Interesting. Interesting, because this is perspective here. The accrued expense and deferred revenue. So if I see myself a company, so accrued expense are obligations. There are obligations that I need to pay for good and service that I receive. Okay, such as wage and salary, rent, interest, wage and salary, rent, in yeah, wage and salary, rent, utilities, and taxes. This is funny because, especially, of course, if you are if you are a person, especially on rent, that represent is a deferred revenue for the that represents a deferred revenue for you. In Spanish is una ganancia diferida. It's something that I already paid for that, but I haven't received that. Okay, or payment that a company made in advance for good or service that has not been yet delivered or provided. Okay, so for example, is subscription service, prepaid maintenance service, and gift card. Most of the time, the rent, of course, for company, this is something different, but for natural people, most of the time you have to pay that in advance. Okay, most of the time you have to pay that in advance to enjoy that. Okay. So there's a different treatment between a company and a natural person here. It's a complete different treatment. Okay. Cool. According to ChatGPT, of course. Then we look at the operating liabilities. So okay, I already saw about the accounts payable, any obligations that some that you have, or as a company, that you have to pay for. Okay, example of account payable. Accounts payable here. Okay, so there are amount of money that a company owns to either supplier or vendors for goods and service that have been received but not yet paid. Accounts payable such as raw material, office supply, service. Managing accounts payable is important to maintain positive relationship with suppliers and vendors, as well as for managing the company cash flow and financial position. Timely paying accounts payable helps to establish exactly. Timely payment of accounts payable helps to establish trust and reliability with the suppliers, and can also help to avoid late payment fees and interest charge. So accounts payable are usually short-term liabilities that are expected to be paid within specified periods, such as 30 to 60 days. The payment terms are usually agreed upon between the company and its supplier. And most of the time, from a company perspective, account payables refer to the amount of money that a company owns to the supplier or vendors for good or service that has been received but not yet paid for. Okay, in other words, uh, they are good and service they have received but have not bought, not yet but not yet paid for. Okay, not yet paid for. So just to recap these three operating liabilities. You have accounts receivable, accounts payable, which is the amount of money that you own to suppliers for good and service that you receive. Okay. And for example, you have these raw materials. If a company purchases raw material from a supplier, the amount owed to the supplier will be considered accounts payable until the invoice is paid. Office supply, if a company purchases office supply from a vendor, the amount owed to the vendor will be considered account payable until the invoice is paid. So raw materials, if a company purchases raw material from a supplier, the amount owed to the supplier will be considered account payable until the invoice is paid. So raw materials, office supplies, and service. So having a business is something that you really need to have a thick skin for it, because you need to be reliable. You need to be reliable, my friend. And I'm not saying anything new, okay? So raw materials, office supplies, and service. And I say reliable because, okay, if you as a company buy raw materials to make chairs, for example, hipster chairs, so the amount that you own to the supplier will be considered an account payable. In Spanish, cuentas por pagar. Accounts payable. Okay. So, to recap, accounts payable is amount of money that you own to your suppliers for good and service that you have received. Or for good and service that have been received. Okay? Usually accounts payables are short-term liabilities, such as 30 to 60 days. Okay? For example, raw materials, a company may purchase raw material from a supplier, and that amount owed to the supplier represent is an account an accounts payable until the invoice is paid. Then you have office supplies. If a company purchases office supply from a vendor, so the subtle difference between a supplier and the vendor, in Spanish, proveedor, and a vendor is the same. That provides something new, such as a product or service. Especially a trader in the street, a vendor, a person, company offering something for sale. Okay, a supply is something that that provides something needed, such as a product or service, whereas a vendor is someone that sells something, is offering something. Supply is something that you need, and a vendor is someone that is selling a good or service. Okay, so that is the difference between supplier and a vendor. You need this, you don't. Okay, supplier and a vendor. Okay, so again, to recap, I know this is something important, so repeat is an important learning process. Yeah. So accounts payable. They are money. So accounts payable, money that you own to your suppliers or vendors for good and service that have been received. Okay, for good or service that have been received. Usually, these accounts payable are usually short-term liabilities within 30 to 60 days, previous company agreement, and it can be raw materials. So a company may purchase raw materials from a supplier, and the amount owed to them represents an accounts payable until the invoice is paid. So office supplies, again, if a company purchases the office supplies to a vendor, right? So the amount owed to the vendor, well, it represents an accounts receivable until the invoice is paid. The same for a service. So if a company receives a service from a contractor or consulting, the amount owed to the contractor or consulting will be considered accounts payable until the invoice is paid. So this is the exam. So this is what is account payable, and it is example, all right? And then I look at accrue expense, which are expense that a company incur for service that has been received, but not delivered yet, delivered. Okay, such as wage and salary, rent, utility, and taxes. And then I look at revenue, deferred revenue, which are expense, or deferred revenue which are expense, deferred revenue. So are uh, deferred revenue are payments that a company uh, yeah accrue receivables, uh, accrue receivable or accrue expense is money that I own for service that I receive. Okay, such as wage and salaries, utility, taxes, and rent, right? So money that I own for service that I receive. And this is accrue expense. And deferred revenue is payment that I made for service that I haven't received. Okay, is payment that I made, or is payment that I did for good or service that have not been yet delivered or provide. Okay, so in this deferred revenue, okay, is subscriptions, prepay, maintenance, and gift card. Okay, so with that, that'll be all for this video. Take care.